Hey everyone, my name is Keshav, and I'm here today with my partners Andy McMullen and Derek Alexandrenko. Thank you for joining us today. We'll be discussing our latest investment opportunity, the Crest, 98 units built to rent in Lafayette, Louisiana. We'll talk for about 20 minutes about the opportunity, and along the way, please feel free to throw your questions in the chat. If we're doing a good job, then we should be hitting most of them, and we'll get to any remaining questions at the end. And with that, let's get started. So here's what our roadmap looks like. We're going to go into a little bit about the team, our background and experience, the investment opportunity itself, some of the financials, and end with any questions that you have for us and next steps. So a quick introduction about ourselves, Clive Capital. We provide off-market cash flowing opportunities by partnering with some of the very best operators, like the two we have on today with us here. And we make sure that we deliver tax advantages, cash flow, appreciation, a lot of the great things that make real estate a great asset class to bet on to create generational wealth. And our mission here is to transform lives by creating legacy and investing in communities to create a positive impact. And our vision is to become the premier built-to-rent and syndication firm in this space. And here's a little bit of our background and track record. We have Andy McMullen and Derek Alexandrenko here today with us. Andrew G is a little too busy to be here with us today, and myself. And as you guys all know, a great sponsor team can take a bad deal and hit it out of the park. And conversely, an inexperienced sponsor team can take a home run and strike out. So who are you investing with when you invest in the Crest? Should you invest in the Crest? This isn't just any syndication group that's popped up over the last 5 years. We've been syndicating before the 2008 downturn, through that downturn up until today. And through that, we have currently over $1.2 billion in assets under management, raised over $400 million from investors, currently manage over 3,000 units, and have a combined 60 years of experience. So we've been around the block a few times, to say the least. And so I'll let Andy here introduce himself and our partners.
Sure. So, my background has I've been in this game a little over 20 years, mostly in syndications, buildings and built-to-rent projects, most recently. So, I think with a project like this, really the team is most important. So, we've got, one of the premier companies in the country that's doing, construction, that's doing acquisition, Hammerhead. Chris Vaught has, years of experience working on institutional projects, development, entitlements, all the way through exit, as a landscape architect. And then Derek Alexandrenko has been in the built-to-rent space longer than most people, over 10 years, 15 years, and kind of done a lot of, small projects, and then recently sold into some larger projects over the last few years. But the reason I think that's so important, Andrew G, he's been in the game probably 25 years, on the syndication, fund management level, asset management level, associated with founder of Mag Capital, who's, one of the premier real estate firms in the country. So a really strong team. I think the important thing to think about here is if you kind of define the roles. So the hammerhead would be kind of the boots on the ground. And Andrew would be on the asset management side, setting up the loans. We've got I think the best lender in the country at this point, which, I know more people aren't saying that because there's a lot of changes in the lending game, but I think it is a credit to kind of our experience that we do have those types of capital relationships. So that's a little bit about group, and I'm sure we'll get into it more as we continue.
And Derek, why don't you hop on and go through your experience for the crowd here?
Yeah, Andy covered it pretty well. But I was born and raised here in Louisiana, which is where the Crest project is. Graduated from LSU and also the University of Louisiana in my master's degree in business there. And I've been doing real estate since 2002. Started just buying homes, renovating them, and rinse and repeat. And over the years, became a licensed general contractor. Started building them, which is much easier than trying to find the diamond in the rough and remodel it. With this model, we get to design the houses exactly how we want and know how a finished product will end up. So it's just a better overall process we found over the years in the end result that works out very well. And teaming up with experienced operators and asset managers has allowed us to increase the unit count that we're doing. So I'm excited about what we're doing and the projects we have coming up.
Thanks, Derek. And Andy, anything else you want to mention about Andrew G's experience? I know we went through.
Well, yeah, I mean, I just think yeah, he's probably, if you could kind of name who are the top operators in the country, you got to put him on the list, right? I mean, his experience is incredible. The number of deals that he's been in, development, acquisitions, just kind of founding, an incredible group in Mag Capital. So, we've known, Derek and I have known him for the last 4 years. We're working on I think we're on our 4th deal together. And so, I think that synergy with the team is important. But when you have someone with that breadth of experience and resources, and another part of our team that I think people underestimate when they're looking at other operators is, do they have the liquidity and net worth to kind of, brave the storm, as it were. So we're just really fortunate to have him as part of our team.
Definitely. And lastly, myself, I'm the founder of Clive Capital, where we focus on partnering with folks like Andy and Derek to deliver these off-market opportunities, both in the multifamily value add and build-to-rent space. Currently, we have 308 units under management and another 248 under construction across 3 markets. And of that portfolio, 98 units is here in this project, which we'll be getting into right now. So we're going to start off with why build to rent, like why is this asset class so exciting? So basic supply and demand is reason number 1, right? According to Freddie Mac, we're short anywhere between 3 to 4 million homes nationally. And currently, it is more expensive to own than it is to rent, as we'll see in a few slides. And this problem is only getting worse as interest rates continue to rise in the Fed's battle against inflation. Build to rent also offers the affordability and density when you compared it to vertical multifamily. But when you compare it to single family, it offers a nice comfort and quality of living with this nice spacious backyards and doggy doors and amenities. And this is also why city planning officials love it as well. And investors love it because it's new, it's exciting, it's not your value add, bread and butter deal that are harder to find nowadays. And the exit strategies, as we'll go into later, are very lucrative. And so when you look at it from the tenant's perspective, the city official's perspective, and investors' perspective, in the words of Michael Scott, it's a win-win-win.
Yes, I love it. By the way, I like to kind of simplify it in like a triad with why built to, especially today, is the kind of favored asset class, amongst Wall Street. One, you mentioned the high rents, right? The rents are increasing still, and that's obviously due to inflation. So rents keep increasing, and that's part of the reason Wall Street still loves it, right? It's yield that they can that they can get for their CalSTRS and CalPERS and all their pension funds, etc. The other is that there's just low supply, right? We just don't have very much housing. I think you got to hear we're 3.8 million units behind. But the thing that you hit on that I want to basically stress is that affordability gap now keeps growing. So when we say affordability gap, the cost for a person to be paying their mortgage every month now is about $850 more than them renting. And that just keeps growing with interest rates as they rise, right? And so what that means is that pool of potential owner is much more likely to rent, and they want to rent nice stuff that doesn't have a stigma, that has the big doggy door, that has all the amenities, has the new tech. And that's part of the reason that not just, operators like us love it, but smart money, sharp money loves it.
Definitely. So what does the process for build to rent look like? It is a development project, and at a high level, we can break it down into 3 phases. Phase 1, the riskiest phase, is the acquisition and legal planning phase. This is where we put the land under an option contract, where we have the option to buy it if the engineering studies go through well, if the city loves what we're doing. And we use this time to basically perform a sanity check on the vision that we have for this plot of dirt and how we can transform it into the community we have in mind. And only if all of our boxes are checked do we go ahead and buy the land. And since we're performing that sanity check, that makes this phase 1, the riskiest. Phase 2 is the horizontal infrastructure. This is where you actually start building. So you'll build the roads, you'll build utilities, the power grid, sewers, etc. Everything you need to lay the foundation to start building your homes. And this is less risky than phase 1, but riskier than phase 3, which is the least riskiest, and that's the vertical construction, which is where you start building the homes in, groups of, let's say, 10 or 20. When you finish up the first group, you'll put it up on the market, and then you'll start on the second group, finish those, put that up on the market, and keep going and building group by group until you're done building out all, in this case, 98 homes. And that's the phase that we're in on our development currently. We're finishing up the horizontal infrastructure. We're starting the safest part of the development, which is the vertical phase. And why now? This alludes to what we were talking about earlier, just to hammer home that point of the affordability gap. And this is as of April 22, right? 6 months ago. This affordability gap has only gotten worse as interest rates continue to rise. So the story behind the opportunity, Derek, do you want to take over this one?
Sure. I had originally acquired this property, a smaller property across the street, and I built out 2 cottage homes on it, and got them leased up. So I really knew what I could expect as far as what kind of rents they would bring in, what the costs were to build those units. And then the tract across the street was a much larger, almost 12-acre tract that I ended up purchasing after that, once I had it proved what kind of rents we could get, with the idea of, building out 5 or 10 per year on my own. But as I, purchased that property on my own, I met Andy and we started talking more about it and looking into it. This was a few years back. It just turned into the expense to do it and the speed with which I wanted to build it. It was better to just put it all into one multifamily project. And, through that time, we've had a lot of things happen with COVID and now the economy. But, the benefit is with this type of property, even though some costs have increased, the rents have increased, we've had to change our modeling quite a few times, as we start proving out higher and higher rents. So it's turned into a great little project for us. And it's a unique one because we have been able to kind of have a head start with the other units that were already there and rented out. So we kind of idea, we were able to test the waters a little bit.
What's interesting, Kate, is a lot of opportunities that are out there in development. You'll have partners that they might have some familiarity with an area, right? And they've just done some research. But imagine you're investing with a partner who basically lives there, went to business school there, has family there, understands kind of all the developments that are going in and around there. And so you can kind of things in a new market, they start coming to focus, and then you kind of see that where the nuances are, right? And what we started to notice is, that there's larger developers coming into these areas that are now secondary and tertiary markets. And it makes sense too, right? If you just considered, driverless cars, right? 10 minutes from the big city is the same as 30 minutes and with a big backyard and less expensive rent and all the amenities that I would want. Lafayette as a market, I think that Wall Street Journal called it the what do they call it there? The happiest place in the country. And mostly because the food and the drinks, but in general, it's just like a great community feel. And as we're building these projects, we try to find areas that have these really good kind of elementary schools where we're renting to a lot of young families. We'll get into that a little bit further along, but I just wanted to iterate the kind of unfair advantage that we have with having a group like Derek with the experience that they have in an area that's right down the street.
Yeah. Very important, boots on the ground. So at a high level, here's what our investment opportunity looks like. This is our vision for the community, the plat, and we'll go into more colorful renderings in a few slides. But we'll be building 98 homes. 8 of those homes are already built, and we're renting them out at $1,700, proving out the market rents like Derek mentioned. We'll be putting in great amenities, large backyards, jogging trails, dog parks, playgrounds, etc. And the horizontal infrastructure is already complete. So we just have these remaining 90 homes to build. And we have those great school ratings as well, 8 out of 10, to bolster our vision for the community. So our investment thesis at a high level, who is this investment for? 1, if you want to diversify outside of traditional value add opportunities. 2, defer your capital gains through 1031 exchanges and minimize taxes with cost segregation. 3, you're more interested in long-term capital growth than you are immediate cash flow. 4, if you're interested in risk mitigated high reward opportunities. And 5, another great reason we all love real estate, especially in this environment, a hedge against inflation. This is the timeline that we're looking at here. So currently we are wrapping up the horizontal infrastructure phase. We hope to have that done. We project we'll have that done by the end of March. And at that point, we will start building homes and renting out those remaining 90 homes at a rate of 6 homes per month, conservatively. We think we can hit 10, but just to be on the safe side, we're going to say 6 because of labor shortages, supply chain issues. You never know in this crazy world what's going to happen.
Yeah, and I would say to that, I mean, just to kind of hit on how conservative the underwriter. I mean, we've got another project in Foley, Alabama. We're building out 15 a month, right? So, 6 is achievable. And when we put more in our underwriting, it's going to look a little bit too good to be true. So we want to be conservative here.
Yeah. Our 98 homes, they're all going to be 3-bed, 2 baths, 1,200 square feet, and we'll be renting them out for $1,700 a month to start. And these are what they look like on the exterior. We're working on, still putting on the finishing touches, but at a high level.
Yeah, come on. We got Casey, get a better picture than that, man. I mean, they look. Aren't you a little bit like we got a picture with the paint at the bottom? I mean, there's.
Yeah, this looks like it's before the sod and the fences, which are
What's
done.
That? Yeah, don't we have one of those? Jeez, I mean, the interiors look like the Taj Mahal, and that one looks like we haven't finished the job.
Yeah,
all right, we'll get some more pictures.
We'll get some better pictures in there. But this is what the bathrooms look like, right? And what the exteriors look like. And the bedrooms also, modern finishes. Derek, anything?
I think what's really cool here too, Kashif, is that Derek's built so many of these products in this area that with each resident, he learns kind of what it is that they like, what it is that's renting, what, amenities people are paying for. And as a result, we get a project with, a big backyard and these beautiful interiors, right? Because most of the residents we know want walking trails for their dogs and doggers and, beautiful new spaces to live in.
Very modern kitchens here. Anything you want to add, Derek?
No, like Andy said, I mean, I've done a lot of iterations of this, floor plan, or to end up with this floor plan. It's moved around a few times, and we get a whole lot into a small footprint. These things are only 1,200 square foot or so, but they feel much larger than that. So through building a lot of them and renting them out over the years, I've gotten like Andy said, the feedback, and kind of end up with a really economical construction process and end product. So.
Nice, yeah. And the transitions from living room to kitchen and vice versa. And keep in mind, these are pictures of homes we've already built. Like, this is the interiors of the homes, the 8 that we have built, and of the remaining 90 that we will be building. And they're up on
Yeah, I think you hit it on the head there. I just want people to understand, like, we're not this isn't a pie in the sky number of 1,700. This is what we're currently getting today. So if we were to underwrite our project, you know, 3%, I think we did 3% increases a year. Inflation's at 12. We know that obviously number is going to be much higher. But again, we want to try to be we want this to be a big win for people. So we're really trying to protect the downside as the most important thing in this market. And as a result, we have to be really conservative in underwriting, but it's got a big upside potential in this deal.
Yeah. And this is the 3D rendering. So it's obviously hard to conceptualize what the finished product is going to look like in development. So we are partnering with a 3D rendering company, Applet 3D, and these are some of the initial renderings that they've provided us, based on the picture that we painted that we have in our minds. And soon enough, we'll have a 3D drone fly-through ready for you all as well. So let's dig into some of the numbers. At a high level, our total project cost here of everything you saw is going to be 16.2 million. And we're raising 4 million from investors approximately, with the remaining 12.2 coming from Arbor, our lender.
Yes, so I would say just the number that stands out there is the contingency, right? I mean, that's like a 13-14% contingency. Most development projects that you'll see are 5. And we've already raised about 3 million, 3.2, so just about another 800,000 to go in equity.
Exactly. And our timeline, like we said, we are finishing up the horizontal infrastructure. We'll have that done by the end of March 2023. At that point, we'll start building the homes. Conservatively 6 a month, hopefully more like 10, probably more like 10 a month, and finish construction of the remaining 90 homes by spring 2025.
No, Derek's going to beat that. I have full confidence.
And here are some numbers from the market. So we'll be looking at our apartment complexes, single family homes, and another build-to-rent community in the area also. So if you look at a lot of the 3-bed, 2-bath prices here, you'll see that they're pretty in line with the $1,700 tag we have in mind. And I would say that anything, that you see lower or higher, things to consider about our community are that it's a hybrid of apartment and home living. So it's new Class A builds. You're not being cramped next to, 2 neighbors on each side, having to listen to their, loudspeakers or TV at night. You have space, you have a nice fence, nice backyard to yourself. And you also have apartment amenities, right? You have a doggy park, you have these jogging trails, etc.
Yeah, I would say that, and I don't think we're doing a pool. I mean, there'll be a pond there, there'll be color, but
A pond, yeah.
all those other comps, what they don't have, Keshav, is they don't have the big backyard. I mean, that's the draw, right? I mean, if you just think about what you'd be looking for in a home that was the new kind of technology, the new feel, the community feel, we'll have the playground, we'll have the park, we'll have the dog park, we'll have the trails, we'll have dog yoga, all that. No, we won't do dog yoga, but we will have these yards that people want their dogs. I mean, 70% of built to rent, consumer, I guess if you want to call it, or resident, they have these guys, these dogs that they want to have some space for them.
Yeah. And if we want a true like apples to apples comparison, here's another built to rent community in the area, and they're renting their 3 bedrooms for $1,825 a month. So that just helps us feel more confident in our $1,700 price tag.
And even that area doesn't have the yards that we do, right, Derek? Or am I wrong about that?
That one, they have just a side yard, half of one, like in between the houses, no rear porch or yard.
Yeah.
And lastly, the thing we can draw comparisons to are single family homes, right? The price tags here, again, fairly in line with the $1,700 mark to further prove out, the market rent that we're charging. And let's round it out with some fun projected financials and risk mitigants. So we're projecting for our investors a 17.5% IRR over a 4-year hold period, at the end of which we plan on selling given market conditions, but we'll always do what's best for our investors. And an equity multiple of 1.86, meaning you're getting 86% return on your investment in 4 years. And if you want to average that over each year, that's 21, 22% return. Yield on cost, 7.8%. And obviously, we have our bonus depreciation as well, as is with any other real estate syndication project. On the risk mitigant side, right, construction is very risky, especially in the economy and environment that we're in. So what are we doing to make this safe for our investors? Well, number one, we're bringing you guys on towards the safest part of the construction. We've already built out the horizontal infrastructure. We've already tested the market rent. Now we just have to take this thing across the finish line. Second, like Andy mentioned, we have a 13% contingency reserve in case construction's over budget or delayed because of economic factors, weather, etc. We have an extra 1.3 million, if I'm correct, in the bank for rainy day funds. Besides that, your typical risk mitigants that you would like to see in any other deal, 3% rent and expense growth. We're not banking on the market saving us. 70% break-even occupancy, and an exit cap rate that is 80 bips higher than the current market cap rate. So here we're saying that the market is going to expand at 20 bips per year. And this is in addition to a lot of other things, right? We have a rate cap in place to make sure that even if interest rates go sky high, that at most we're capped around the 9.75 range. We're mitigating risk there. We're assuming that we'll be building 6 homes a month in our underwriting, but realistically, right, with Derek, our expert here, we'll be hitting more like 10 a month. And most importantly, we're not baking in any refinances along the way. We don't know where the environment's going to be in 2 to 3 years when we go to refinance, and we rather not hypothesize about it. We want to give you guys what the worst case scenario is going to look like. Let's say we can't refinance for whatever reason, and we have to pay 9.75% interest for the next 4 years. Even in that grim scenario, building only 6 homes a month, we're still going to be delivering 21 to 22% annualized returns to you, the investors.
Yeah, that's just spot on, Keshav. And the other thing to mention is, in order for us to now achieve that return, rents would not go up more than 3%, right? Which is probably unlikely. If interest rates are going up, rents are probably going up. We'd have to blow through a reserve of contingency of 13%. You'd have to basically predict that we could not refinance or stabilize the property and that we could hold this 4 years. We did this number at 4 years, but even at 5 years, if we had to hold that interest rate, we could. Maybe it's a 16% IRR, but it's still healthy, right? So we understand that in most people's mind, right, it's not like, hey, how do I achieve those mid-20 IRRs? Like, how do I minimize my risk? And that's the underwriting we wanted to put together here is like all the stuff that's going to go wrong. How do we account for that? And can we still deliver that return to the investors? Because this is much better than them putting that in the market or on the mattress or bonds or wherever. So yeah, thanks for hitting those mitigants. I think that's the most important piece of this whole webinar.
Yeah. And so how will our investors be paid? We are structuring this in an IRR-based waterfall. So what that means is investors will receive any accrued but unpaid 9% preferred return. And that's pretty standard across a lot of these syndications. But not only that, investors will receive 100% of their originally invested capital back as well. Once investors have achieved a 9% preferred return and a return of capital, that is when our partnership starts taking a share of the profits. And that's I guess, another way we mitigate risk for you. Until you've returned your capital and some more, we do not take share in the profits. And so this is a 506c opportunity open to accredited investors only. The minimum investment is $50,000. IRA and retirement funds are accepted. And as always, first come, first served. Some frequently asked questions here. Can I sell at any point, or do I have to stay in this investment opportunity for 4 years? We haven't had a problem in getting our investors out of our investments previously, but we don't promise anything. If you would like to join us on this, we recommend that you plan on holding your investment for 4 years. How will we handle a dynamic environment where interest rates and labor and material pricing is all over the place? As far as the interest rates go, we have bought an interest rate cap. And for the labor and material pricing, we have $1.3 million in the bank, 13%, where the standard is usually 5% for contingency reserves. Will there be refinances along the way? We plan for there to be, but when you make your investment, again, be on the safe side, assume that we can't refinance until we go to sell. And our exit strategy is we plan on selling the development once we've stabilized it, hopefully earlier than 4 years, but we're going to be conservative there. And lastly, how do the different development phases affect investors? Like we mentioned, we're on phase 3 now, the vertical infrastructure phase. A lot of the hard work and the risk has already been taken out for you as the investor. Now we just have to take this thing home. And it's the least riskiest portion of the development.
And the other thing we should add just on the exit strategy, Keshav, I know we're going a little long here, but it's really key that all of these are individually platted. So if at any point in time we decided, hey, look, let's just sell off 10 or sell off 20 or sell off 30, we can do that. Our likely scenario is that we would sell the entire project to an investor. It's either an institutional investor, which there's a lot of interest in these projects in this area and these areas, or we could sell to a multifamily buyer or even smaller, mom and pop. So wanted to add that there's multiple exit strategies here, which is another risk mitigant.
Yep. So there's a QR code here at the bottom that'll take you to the Clive Capital website. Feel free to ask your questions there. As far as what next steps would look like, first step would be review and submit a soft commitment on the website that I'll pull up here shortly. Feel free to reach out to me, and we'll work together to get the electronic package signed. Once that's signed, the team will review it and accept it. Once that's been accepted, investors can wire their funds before the deal closes or before we close our funding. And in the beginning of next year, we'll start our vertical construction. So go here or scan the QR code to place your non-binding self-commitment, schedule a calendar call with me here on the right. And here's my phone number and my email. And with that, we'll open it up to any questions.
One thing I get asked a lot that I think may be helpful to people is why are you going out now again for money? You guys were doing this a couple months back, 3 months back. And it's quite simple. Our lender, after we had signed, came back and said, "Hey, look, this market is incredibly volatile. There's warehouse lines that are being shut down. Banks are not going to be able to lend through the end of the year, right? And that's because interest go up. So that means that Wall Street needs their spread. So they've got basically warehouse lines that if Goldman Sachs decides that, hey, look, they need to make a certain spread, then that means all the larger banks need to up their fees or reduce their risk by lowering the loan to cost, which is ultimately what happened to us. So we had a loan to cost that was at 80%, reduced down to 75%, which for the investor much safer deal, right? For us, it sucks because we had closed and we were ready to go. Now we've got to go and we've got to raise more money. So right now we got about 800,000. On the other side of that, the lender that we went is probably the premier lender in the country. Their president of the bank is approving our deal, right? Yesterday we got the approval on kind of that loan. But I think it basically, the reason that we were able to get that is because we had liquidity, net worth, and the track record that is able to navigate this type of deal. So, I just like being fully transparent. We came into this deal. I think lumber was at like 1,200 a 1,000 board. I think it was something like that. I mean, we've seen supply chain issues. We've seen, I think concrete actually has probably gone up a little bit. Lumber's come down. There's been a lot in every deal there is. Like if there's not a problem in a deal, then it's probably there's something that's coming, right? You're either not minding the store. So I just think it speaks to kind of team. I can't credit for it, but the Derricks and the Andrews and the Cases of the world, the guys that are kind of pulling all these pieces together to make things happen, that's the reason that you get 17-18% safe IRR with a huge upside if you decide to refi or rents go up. But you got to be able to manage the downside, and you got to be able to manage the kind of stormy, waters that we've been experiencing over the last few months. And so that's why I believe in this deal more than I did even then, because I know of what the partnerships that we've got that are built and the money that we've got behind it and the speed with which we're actually already building, So Derek, any other comment to make about?
Well, I know a question we get a lot.
Gotta lose some hair, right?
Yeah. Is always just because of the geographical location, hurricanes, and how concerned about hurricanes. The best way I can explain it is I've lived here for almost 40 years, and I've never had to evacuate for a hurricane. We've gone through Hurricane Andrew, quite a few other named storms. Never had any significant damage to a home that I've lived in or owned. I have about 50 houses spread around town. So generally when a hurricane comes through, it could tear off a couple shingles if it's a bad storm, or knock over some wood privacy fences, things of that nature. So I've never had to file a hurricane insurance claim on any property. So, I mean, if you get a direct hit from a large theoretical storm, obviously when there's that small 25-mile radius right in the center of the storm, where if you're on the coast within, a certain distance, it does create catastrophic damage, mostly storm surge, things of that nature. But we're far enough away from the coast. We don't have any storm surge danger in our area. We're not in a flood zone at all. So I think that we've, as far as geographical location, hurricane risk is really not something we have too much consideration or risk exposure to, just based on our experiences here. So I get asked, quite a bit.
Yeah, and the other thing we could ask about too, Derek, is just about the build, right? I mean, we're building these things like you guys are building these things like mini tanks, right? I mean, you got basically one foundation running through the house. I mean, talk a little bit about that.
Yeah, I mean they're 9-foot exterior walls. They got cement board siding, wind rated, roof shingles. So there aren't a lot of nooks and crannies for wind to grab and tear things off. They're basically rectangles with a single pitch roof. So they're very simple, but very strong construction, and they hold up well. So we think that over the years that'll really result in fewer repairs that are needed and things of that nature.
Cool. We'll give it another minute or so here for any questions.
Gosh, seems like, we try to address as many of these questions in the deck. I think the questions that I get mostly is, where's this economy going? Where are we seeing built to rent in general? I spent a lot of time with lenders and operators at this conference a couple of weeks back. The truth is nobody knows me, right? That's the truth. But there is money out there. There is a benefit to built to rent, in the sense that there is low supply, that there are the rising interest rates. If I had my druthers, I'd prefer to have lower interest rates, of course. But if I, am I glad that I'm in the built to rent space? Yes. I mean, that's kind of where we can benefit from this low supply, inflationary, the timetable. And the other thing is just real estate in general, right? I mean, you look at, I was talking to a financial advisor yesterday, and these scary times. He's much conservative in his, he handled my dad's money, and he's saying, look, I remember what was like in 2000, as do I, as Derek and Andrew. It shut off, right? Financing just shut off. There was no money at all, right? So up until that point, everything was regional. You'd have a market that was ascending, you'd have a market that was descending, and depending on the area. And I think we're starting to see that again now, because this is different than 2008. There's still going to be money there, but it's going to be poured into certain asset classes. It's going to be poured into certain markets, right? And I think that's where we're poised for kind of identifying those things. And obviously, and trust us that every day that we're doing our underwriting, we're thinking about how do we, mitigate the downside.
Well, I think we did a good job. No questions here. So thanks for coming on, Derek and Andy, and presenting about our latest investment opportunity. Again, at a high level, $800K left in funding, and we just need to build out the remaining 90 homes, have our loan in place and all that good stuff, mitigated the risk, and we hope to hear from you very soon. Have a good one.